Good evening, guys, and thank you for inviting me. I know that the whole idea was that I would turn up face to face in Ballarat. It would have been nice. It would have been a particular part of Australia that I haven't seen yet, but unfortunately, times are still not back to normal. You can tell from how much hair I have on my head, and so we do this online, which is obviously not necessarily a problem. When I got the invitation, I was inspired by a book that's called What Works on Wall Street. And for those who can see, I don't know if you can, but it's a 700-pager. It's international bestseller, and it tells you what works on Wall Street and not necessarily what works on the ASX in Australia. So I thought, let's have a look at those particular things that work in Australia on the ASX based on my own research. And of course, I have access to a lot of research done by others, like stockbrokers, fund managers, etc. And I'll be throwing that one in. You do know that I don't provide financial advice. All the rest is just sharing my insights. I'm not necessarily devising any strategies today, but I'm pretty certain that all the events and the observations I'm sharing, that you will be able to use them in your own strategies and in your own participation in the share market. Now, before we come to the point where I will tell you what works on Wall Street, on the ASX, I have a broader macro point to share with you. And if you are familiar with my presentations from the past and my research over the years, it's one of the central themes I constantly put forward to investors is the character of the share market has changed. And that might seem a bit strange because there's plenty of other experts out there that will tell you it never is different. But I really differ in view of this. And on occasion, I find more and more evidence in other people's research. And in this case, this is a chart based on research done by UBS. And what you see is on the top part is an amalgamation of all the dividend payers in the Australian share market in the ASX 200 that pay dividends and franking. And you can tell it's on a relative basis that until 2014, that group, that segment in the market outperformed the rest of the market pretty much on a steady basis. While the non-dividend payers and those who pay dividends without franking, they clearly underperformed, and that dynamic has changed since 2014. Now, I've seen other research where the changes in 2013, let's just say it is around that time. And I'm pretty certain as well that while this is not necessarily the theme of today's presentation, I will give you some strong hints and explanations today why the dynamic has changed in the Australian share market and why it no longer is as easy as simply owning the banks and catching in on the dividends and the franking and then outperforming the rest of the investors who do different things. Now, if I were to summarize the key pillars under the share market today in Australia, then I come to these four key points in the share market, and two of them I believe investors overemphasize in importance, and two of them are not well understood and are regularly underestimated, underappreciated, and do not get enough attention. Now, I believe that the value part is something that investors tend to overestimate. They put too much value in trying to buy stocks on the cheap, and they're missing out on lots and lots and lots of opportunities. The other element that is steadily overemphasized is the dividends. Investors are on too many occasions blinded by the yield that's on offer, and they forget that there's a few other elements that they should be paying attention to. Those two other elements, key two other elements, I believe, are the quality of the companies, which I believe if you are a long-term investor, this should be key in your portfolio and key in your considerations. But unfortunately, I always see that it seldom is. And the other element, which is, I think, something that has increasingly started playing a role, since 2013, 2014 in Australia is the disruption that we have from technology or otherwise in the economy, and that has translated in the share market as well. Now, the interaction between those four elements, I believe, today should be the center of anyone who engages in investing in the share market. And let's get now to business. Now, what exactly works in the Australian share market? Now, it won't surprise anyone that I'm starting with dividends. I mean, Australia is probably the dividend capital in the world. And of course, a lot of things, a lot of phenomena, a lot of trends, a lot of observations that can be made from the share market, they revolve around dividends. And the standard observation to make is that it's the 45-day rule, which essentially I'm assuming that most of you will be aware of, that if you want to claim your franking from the tax office, you have to be able to show that at the very least, you were shareholder, you were owner of the equity for 45 days, at least. Otherwise, you won't be able to claim your franking from the tax office. The problem with that is that the 45 days rule for starters is 47 days. Because it excludes the day that you purchased the shares and it excludes the day that you sold them. So be careful with the 45 days rules. Don't forget the other 2 days. So if this is center of your strategy, make sure you have at least 47 days. Now, what we see in Australia is because we've obviously given investors a window in which they have to collect their dividends and own the shares, is that this is a phenomenon that is regularly being observed as a factor of influence on share prices, in particular for popular dividend-paying stocks, and in particular if they are large caps. I think one of the examples that I thought this year is very, very striking is Commonwealth Bank. Commonwealth Bank, as you probably all know, it declared its financial results in August. It pays its dividend not much later. And this year in particular, it's quite striking what happened in the run-up to that announcement and in the run-up to the dividend payout. And what you can clearly see is that the share price, from the moment that investors start concentrating on that dividend, it runs up quite strongly, and then it comes down again, and then it deflates. Of course, it doesn't always exactly happen in this particular way. I mean, dividends are not the only thing that is of importance. But what is quite striking, and this is something that pops up regularly in research also done by other experts, is that within that window of 45 days-ish for a stock like the Commonwealth Bank, you will find that the share price at some stage starts trending upwards. And it usually peaks just before the event. So it's just before the result announcement with the dividend, or just before that the dividend is paid out. So this information, of course, you can use when you would purchase a stock, or not to get too excited about improving prospects for the Commonwealth Bank, for example, because this is all about the dividends essentially. Now, Commonwealth Bank is actually the exception, because 3 of the other major banks are about to report their results in the coming weeks. And we are at the moment in that 45 days window. So I would expect that we probably will see, in particular, since we seem to have left the major volatility of September, October now behind us, I would expect that we would probably see something similar happening in the share prices of the other banks. And because the banks are so important for the share market itself, with a large weighting, that it's not by coincidence probably that on average, November is a very, very strong month for the Australian share market. And the share market often outperforms international peers. And there's probably a connection here in that 45 days window where investors start focusing on what lies ahead, which usually is a quite a big dividend, and this year it will be a lot higher because the banks, of course, they had to cut their dividends last year, which is probably one of the reasons why the share price went up that high for the Commonwealth Bank. What works in Australia? We're staying with the dividends for the time being. Number two, and this is actually international, but it in particular works in Australia because Australia pays high dividends. If you are interested in income from the share market, then the superior strategy is to combine dividends, income, with growth. And this is at the same time a mistake that is too often made by investors. Now, I've emphasized this in the past in different presentations, and it is one of the key elements I try to get across to investors who are interested in income from the share market, because too often the mistake is made by only focusing on the dividend. Now, the irony here is that you will get your superior investment return if you combine dividends with growth. The second best strategy, and this is backed up by plenty of academic research done, the second best strategy is if you simply have stocks with growth. The worst strategy over a long time is if you have simply income, dividends, and no growth. So it's very important that we don't forget that whatever we invest in, the company still has to have growth. Once it falls without growth, we're actually engaging in not only a higher risk strategy, with sort of keeping our fingers crossed that nothing untowards might happen, but we're basically also reverting to a strategy that over time is simply the worst in the share market. And I have a few examples for you to prove that and to put some more evidence to it, so more meat instead of just simply giving you the facts. And this is a story that I wrote about 10 years ago, by the way, and it caused quite a lot of attention at that time. And I thought, like, I might as well fish it up again because it stays relevant and it illustrates perfectly what I just told you. And what I did in 2011 is I said, let's create a scenario where we have the opportunity to go back to 2003 to January. And we know what comes next. So we know in January 2003 that we are climbing out of the bear market and there's a commodity super cycle about to be unleashed upon us. And we have the choice between two stocks. One is Rio Tinto and the other one is a relatively small retailer called David Jones, at the time still listed. And of course, if I give people the choice, which one would you pick? I've yet to meet the first person that said to me, David Jones. So everyone goes, of course, you go for Rio Tinto. The super cycle is coming. And if you look at the numbers, you would pat yourself on the shoulder. You would think like, I'm a genius. I've done really, really well. Over that period of 7 or 8 years, you would have accumulated the capital by 153%. And you would have added 32% in dividends for a total return of 185%. Now, you've done well, but there's no discussion about it. You think you did the right choice. But if you do the numbers and you go for an alternative scenario, then the return that you missed out on, now that's gut-wrenching. Right? That's like missing the lottery. Because if you do the numbers on David Jones, then the capital appreciation would be more than 300%, which is already more than you would get out of your Rio Tinto total return. And the dividends only in accumulation were 163%. So the dividends were almost higher than the total return out of Rio Tinto. And that, I think, is the perfect illustration of what happens if you accumulate dividends with growth over. And this is only about 7 or 8 years, admittedly, of relatively strong growth in those years in Australia. And we do come from a low starting point because we're climbing out of the bear market, so everything is cheap. But nevertheless, I think the numbers don't lie. You know what I mean? Nobody would have chosen David Jones, yet David Jones was by far the superior investment opportunity here. One of the reasons, of course, why the dividend of Rio Tinto didn't appreciate by that much is because in the super cycle, the likes of Rio Tinto and BHP, they spent billions of dollars in expanding their operations, of course, and that then goes not to the shareholder. Another example, which I believe is equally iconic as the David Jones versus Rio Tinto story, is CSL against Telstra. Now, Telstra, we might all remember, listed in the late 90s, and it was from the get-go a dividend stock. CSL listed a handful of years before that, but if in 1998 you had the choice between Telstra and CSL, and nobody, I've yet to meet the first person that says I buy CSL for the dividends. Nobody buys CSL for the dividends, and everyone buys Telstra for the dividends. Now, the irony is that if you had ignored Telstra at the IPO date, and you had bought CSL shares, and you kept both until today, then now today you are receiving more dividends from CSL than you are from Telstra. And that's quite astonishing because nobody buys CSL for the dividends. Now, the other element, of course, is that because CSL has grown so strongly over that period, it's because, of course, the share price of CSL also is a lot higher today than it was in 1998. While Telstra, on the other hand, has continuously struggled, never had momentum for longer than a year or two, and ultimately had to cut their dividends quite a number of times. And that share price, of course, has with the occasional rally it had for a while, it hasn't really done a lot. So what you see here is, again, one of the examples that if you ignore this, that there is no growth behind the dividends, that you're actually doing yourself not much of a favor, although you might think that you do in the short term. And of course, the big surprise here is that a stock that is not known for its dividend, because its valuation is always that high, this actually becomes a better dividend payer than its alternative, which is quite astonishing, but again, proves the thesis. Now, what works in Australia? One thing I think that is not explained well enough to investors is that the share market is actually quite a good indicator in how much risk there is to the dividends. And I devised this little this little indicator, I should say, in 2015 when I published my first book, which was called Change. There you go. It was called Change, right? And so the things were changing, and because we have compressed bond yields to a very low level, we've also compressed as a result the yield spectrum on the share market, and it can be read as an indicator of how much the share market thinks that there is certainty around the prognosis, the projections, and the outlook for a company, and how much doubt there is and how much risk the share market perceives with certain companies. If today a stock is offering you forward-looking 6 or 7% in yield, I believe you really have to question, like, how much risk is there. And if I can hark back to the previous slide, Telstra on occasion has traded on 7, 8, 9. I remember at one stage even at 11% yield, supposedly because ultimately the share market was correct and the share price had to fall and the dividend had to be cut. I believe, and this is years ago, that the sweet spot in this metric here is around the 4% yield. If you can get an industrial stock at 4%, it probably has enough growth under the belt to make it a much more attractive proposition than higher yields without growth. In recent times, the share market probably has revalued even higher. So it may well be that sweet spot now is closer to 3% than it is to 4%. The share market always changes, but nevertheless, the green zone on this little indicator I've created here is between 0 and 4. And that's, of course, where you have high growth companies with potentially a lot of sustainability under their belt. And if you can add a yield on that, then you can obviously, like in the examples I've shown with CSL and with David Jones, you can ultimately come, and that's where your superior investment returns come from, of course. Now, one of the things that is not well understood by investors, and I've already hinted at it a little bit earlier, and it also appears in the overview of the yields I just showed you with the indicator I created. It's not just about risk. There's also an element of quality in there. And usually you seldom hear people talk about quality because it's a little bit more difficult to pin down. It's much easier to say a certain share price is cheap, or this much of dividend yield seems to be on offer. Now, one of the pillars under my research is I tend to focus on quality a lot. I think quality counts if you are an investor in beyond the immediate, beyond the short term, beyond the next few months. If you are an investor in the share market for the longer term, quality is something that you should take on board. And one of the obvious examples, I thought, because we're talking dividends, we're talking banks, we're talking franking, I think the obvious example here is Commonwealth Bank in Australia. What this chart shows you is the premium valuation that investors put on the Commonwealth Bank share price relative to all the other banks. And you can tell with a very rare exception, Commonwealth Bank trades constantly on a premium, and sometimes that premium gets really, really high. Now, as a result of this, Commonwealth Bank offers the lowest yield in the sector and has been offering the lowest yield for as long as I've been in Australia, which is now 2 decades. And I hope we all understand that it's not because Commonwealth Bank pays out less. It pays out as much as the other banks. It's just that its share price trades at a premium. And the yield on offer is always in relationship to how highly the share price is valued as well. And that means so you get the highest valuation, you get the lowest yield. And that as a result means that investors buy their stockbrokers, buy their financial planners, including some of the fund managers, if you hear them, they're constantly referring investors to the other banks because they're cheaper. And that's my experience and my observation shows is not the right way of looking at this, because here was an overview, and I haven't updated it now. I did this a few years ago, but again, the numbers don't lie. And what I did a few years ago is I distinguished 3 different periods since the late 1990s until 2017. And I had a look at what each of the major banks had done in performance for their shareholders, ex-dividends. And you can clearly see Commonwealth Bank is the second one after ANZ because I put them alphabetically. In each period, if it's the good times or the bad times, in each period, the Commonwealth Bank has clearly the best performance out of all the banks. And that completely, again, puts that whole principle on its head that you should buy the cheapest one with the highest yield. Actually, the opposite is true. You buy the quality one with the lowest yield, but the best growth and the best franchise that the Australian share market offers. And of course, I've now used Commonwealth Bank, but this example can be used in other sectors as well. What works in Australia? Well, one thing I've already hinted at with the example of Telstra is that one thing you should avoid almost at all costs is when companies either cut their dividends or abandon paying a dividend altogether. And of course, by the time the companies announce this, it's probably already too late because you can't get out. But so it does pay attention. It does pay to pay attention in advance whether the dynamics under the dividend, the dynamics under the company or in the sector are changing and in a negative way. What this chart, by the way, is based on American data, but it definitely applies in Australia, and probably even more, is that you can clearly see on the left-hand side, that is the category of stocks that is the best performer between 1972 and 2010. And which category of stocks is this? These are the dividend payers that grow their dividends year in, year out, so year after year. Or it also includes companies that didn't used to pay a dividend, but start paying a dividend. And you can tell from here that those are the ones you want to have in your portfolio, basically. The ones you don't want to have in your portfolio is the only category here that is in the negative way. And those are the dividend payers who have to cut their dividends or have to stop paying dividends, like, for example, an AMP had to do recently. I mean, if you still have a static paying, dividend paying stock, you're not doing too badly here. You're still having a relatively good return, but it's hard. It hardly beats the index. And it's obviously you're missing out on so much more in return. Again, as I said earlier on a different slide, the superior strategy is if you somehow can combine dividend with growth. Now, one of the strategies you might look into at some point, and I did this in the past myself, is that sometimes when a company lists on the stock exchange, because it has so much costs because of the listing process itself, sometimes it doesn't generally pay a full dividend in year one or in the first year after listing just yet. But it sort of announces in the IPO document that it will be paying a full dividend in the subsequent years. Now you can treat that one as almost as a guarantee that the dividend will increase or the next year and the year after. And that often translates into a share price that is well supported, because the share market often doesn't look beyond the first dividend that comes up, and that is then not that high. So that could be something that you can take into consideration. I've done in the past and with success, I must say. What works in Australia? My goodness, if there were any investors here from the US or from Europe, they would not believe what they are about to hear. If you've had contact with your financial planner or your accountant, some of you might be aware of this. I don't think everyone is aware of the true power of franking in Australia that can come into your pocket through share buybacks. Now, we have two types of share buybacks. One is a very general share buyback, where a company decides we're going to buy in X amount of shares. And obviously, the advantage for shareholders is the following year, the total in dividends needs to be shared with less outstanding capital. So you have automatic growth, albeit artificial. It doesn't matter. You still get automatic growth baked in, and that usually helps the share price. Now, there is another very Australia-specific type of buyback, and that is when companies have a surplus, an excess of franking on their balance sheet. And this year, Woolworths is one of such companies, and so they've decided to announce a share buyback off-market directly to their shareholders, and they're going to use their franking. Now, I've done a quick run-up of the numbers of how that actually benefits both the company and the shareholders, and we can discuss who gets the most benefits here. But what happens is that the Woolworths share price trades around $40. What Woolworths tells its shareholders is we're going to buy it in at $34.40. So there's a double-digit discount in here. Now, why would any shareholder trade in their shares at such a large discount and give this obvious advantage to Woolworths? Now, the answer is franking, because Woolworths has such an excess in franking, so they can use it in this transaction, and they can offer you that the capital component of the buyback is less than $4.50, basically. So this creates this unusual situation, so that the difference between $34.40 and let's call it $4.40 for the sake of argument, that $30 per share is made up by franking that Woolworths has on its balance sheet. And that comes to you as a shareholder. So on paper, you're effectively selling your shares for $4. Now, the last time, I don't know the exact date, but the last time that Woolworths shares were trading at $4 is probably in the 1980s. That means that every shareholder today would be selling their shares at face value at a massive loss. If you bought it at, let's say, $9, you're having a loss on paper of 50% of the value of your shares. But you're getting $30 per share in franking, essentially. Now, there's two elements to this. The difference in capital between the $4 you're selling it at and whatever you bought, whatever the price you bought at, you can use for you can offset that as a tax loss on your, and so that means the profits you make elsewhere, they don't count. Basically, you can offset them, and of course the big advantage is that you can also claim back the franking clawback on the $30, even if you don't pay tax. On the quick calculation, some financial planners have calculated that for some shareholders, the true value of this buyback is actually around $47 in total value, and that probably doesn't include the tax loss component. So you can see this is incredibly beneficial for shareholders, and probably one of the reasons why it's so popular amongst financial planners and the like. It also shows you why someone like Harvey Norman is constantly under pressure, because Harvey Norman does have franking in excess on the balance sheet, but doesn't want to do anything about it. Anyway, now I have shocked everyone in Europe and the US, and I hope to you all now that you are now aware of this, and you can talk to your accountant and financial planner next time. We're moving away from dividends and franking now, because of course there is more in Australia than simply dividends and franking. If you are ever interested in going hunting for the best returns in the Australian share market, then maybe your hunting ground should be the ASX 100 outside of the ASX 50. So the sweet spot in Australia is in between the position number 51 and position number 100 in the indices, and you can see here that I'm now relying on other people's research, but you can see here that year in, year out, that seems to be the segment. It's the green one on screen. That seems to be the segment that constantly beats all the other segments, if it's over 10 years, 7 years, 5 years, 3 years. So that is your hunting ground for the best returns. And if you're interested in what type of companies are we talking about now, for example, we just lost, if I talk about this segment, we just lost ResMed because they've just been introduced to ASX Top 50. But you can imagine that performers like ResMed, of course, have done well by climbing up from position number 100 to now being in the top 50. But other companies that come to mind are A2 Milk, you have an Altium in there, you have an Ansell, you have an Bendigo Bank is in there, you have even BlueScope is in there. You have Charter Hall, you have Domino's Pizza is in there, you have Fisher & Paykel Healthcare, you have Magellan, you have Nine Entertainment, you have Aurora, Seek is in there, you have Worley and WiseTech Global. Those are the type of companies that are in that particular segment, and as a group constantly outperform the rest of the Australian share market. One interesting thing to know as well is that when people in the United States talk about small caps, that corresponds with this segment in the Australian share market. But we don't have the Facebooks and the Microsofts and the Apples on our share market. So we talk about mid caps, because in our universe, these are mid cap stocks. But if you compare it to the US, over there, similar companies are called small caps. And that's also one of the things where sometimes a miscommunication takes place, that Australian investors believe that when the Americans talk about small caps, that we have to go really small here. That becomes micro over there. Now, one of the other things that works on the ASX is spin-offs. And that's of course when companies decide, like, this particular part of us, we're gonna give it freedom, and often they're gonna list it in their own right. And I can tell you from personal experience, I have been a very sad, because I was a very loyal and happy shareholder of Dulux Group, for example, which was at one stage, of course, I was spun off from Orica. And I always noticed that people were never paying attention to Dulux because it was never trading on cheap multiples. And the irony here is that by the time it disappeared from the Australian share market on someone else's numbers, it had become the third best performer on the ASX over that period, which goes to show again that by ignoring the likes of Dulux, you're not always doing the right thing. Another company where I've been a shareholder until recently is Aurora, which was spun off by Amcor and has done quite well since the spin-off. Now, most spin-offs, if you take it over a 2-year period since the spin-off, most spin-offs outperform the parent company. Usually not in the first 6 months, sometimes not even the first year, but they somehow get their second win in the second year, and that is usually when they show their colors and they show their performance. So that's maybe some information you can also take on board. However, there's obviously not a guarantee, and we have a few of those spin-offs over the past decade or so haven't really worked out. I mean, one I don't mention here is when Fairfax spun off Trade Me in New Zealand. That was never going to work. To my surprise, Domain Group also has not outperformed Fairfax since the spin-off over the first 2 years. And Coles, when it was spun off by Wesfarmers, has failed to outperform Wesfarmers as well. Now, I think in some of those cases, there's clearly a quality element in play. I don't think too many people were enthusiastic when Tabcorp spun off Echo Entertainment. And I think it's only fair to say that Wesfarmers is a higher quality company than is Coles on its own. And Domain, and I could say this as a long-term shareholder in REA Group, Domain is not an REA Group. I mean, it is of lesser quality. So maybe there is a quality element in play as to why some of those spin-offs don't really work out to expectations. Now, we still have a few other spin-offs, and there is obviously, it's yes undecided, but you can already tell that investors usually are not very keen in jumping on those stocks because they don't really know them, because they've always been part of a larger group. But for example, I've noticed that Endeavour Group has performed quite well since the spin-off from Woolworths. But then United Malt Group hasn't, and the Terra Royalties hasn't also. But these are very, very cyclical companies, so maybe the cycle has something to do with it as well. But I guess the main message here is that if a company spins off assets, it doesn't necessarily mean they are bad assets. It's just that they, for whatever reason, now get the chance to shine in their own right. And for example, we've seen that with SAR32, which performed really, really well after it became independent from BHP. And often investors really need to get their heads around it, because previously they haven't paid attention. There was so much more to pay attention to. Now, the last of the items that definitely works in the Australian share market, and this is, again, I'm assuming is going to surprise many of you. And this is one of the reasons also why I said at the beginning that I believe investors overemphasize the importance of dividends and of value, like trying to get a cheap entry price, and they ignore the quality and the disruption. And in this case, they ignore what is happening in the real world. And one of the things I pay attention to now, I've increasingly started paying attention to, is that if you can identify those companies that obviously are well managed, they have a good balance sheet, they have a good management, all of that, but they are able, or they are carried by a very strong trend, be it in their sector or be it in company specific, then the value of the so-called cheap entry price counts for a lot less. And I've done the numbers on these companies here. And we're talking about the last 10 years for those companies, and for some of them, it's a shorter time span because they weren't listed yet, or 10 years ago. But if you look at the bottom, for example, and I think the numbers really speak for themselves. Over the past 10 years and a little bit, the ASX 200 has appreciated by, let's call it 55%, and then you add the dividends, which makes sense. We used to do 11% in Australia. It has fallen back more towards the 9%. That's the average return you have per year over that period. Now, if you look, for example, what a company like ARB Corp or City Chic, a Goodman Group, a IDP Education, a Technology One, they have done multiples of the share market. Now, even if Technology One has done 20 times the return of the share market and pays a dividend on top of that. Right? Every time you hear people say it's expensive, but that is 1,000% in 10 years. Right? 1,000% in 10 years. I'm pretty certain that we can all imagine how much money we have left on the table by not focusing on companies that have a very strong wind in the sails. And which are some of those trends? Now, for example, ARB Corp, they make accessories for cars, but for a particular type of car. It's the big four-wheel drive. And in the car industry, the trend has gone to the big four-wheel drive. That is the best-selling model worldwide amongst cars. ARB Corp has done an excellent job in becoming the #1 accessories producer for that segment. City Chic Collective, two big trends. One is obesity, the other one is the move to online retailing. Goodman Group, essentially the infrastructure provider for online retailing. Hub24, essentially a disruptor in the financial platform industry, which until not that long ago was completely dominated by companies like AMP and the banks. And these guys come in with better technology and take market share. IDP Education, it's the surge in global, in students from emerging countries that want to study, Anglo-Saxon countries, to go to better schools. Macquarie Group, at the moment, the #1 representative on the ASX, if you want to know about green investing, sustainable investing, ESG investing. NextDC, data, in the cloud, out the cloud, it has to be hosted somewhere. Westmac, it's nowadays linked to what could be called telemedicine. The fact that healthcare is moving out of the hospital into our homes. Technology One is cloud, Zero essentially cloud as well. So those trends, they are so strong that you almost have to be a very bad company to not perform well. And that is obviously one of the characteristics also why it can be argued that the share market did change in 2013 or 2014. Now, this was actually the meat of my presentation today, and I hope at the very least I got you some ideas. A few more things before we go to a Q&A. Apart from sharing my research through these presentations and through my writings to FNArena subscribers, I do run a portfolio, and that's based almost exclusively on the analysis and the research I do. And as you can imagine, the overview I just showed you, that portfolio does contain quite a number of those stocks. It is based on my principle that you find the quality stocks that have multi-year growth paths ahead of them, and those stocks tend to perform well. One of the other elements which I try to do in my writings is that I try to shine a new light on things and at least make people think about whether what they're doing is the right thing, and maybe they should change their ways a couple of times. Sometimes I update a secret report, which can be found by simply putting /secret after the FNArena.com website. And that is always, I think, a delight to read something different that might trigger a few new ideas in your mind. And that is then it. I hope you liked it. I liked it, of course. And I'm from here onwards, I'm open for the Q&A. And so I'm gonna stop the recording and I'm gonna share my screen with you again.